Bloomberg Tech is live from the heart of Silicon Valley with Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Bloomberg reports Anthropic expects to match or top the size of SpaceX's record-setting IPO. Plus, sources say Broadcom's in talks to raise more than $60 billion in debt for an AI chip financing deal that will benefit Anthropic and others. And all eyes on Nvidia. Reporting earnings next week, a lot of pressure on it. Let's get right to our top story. Anthropic's aiming for an IPO that could make history. The company expects to match or even top SpaceX's record-setting debut, which in the first instance raised $75 billion. That's according to sources. The maker of Claude could file publicly as soon as the end of this month. Bloomberg's Shirin Ghaffary leads coverage of Anthropic, and Bloomberg's Liana leads the deals team here at Bloomberg. Both join us with more. Shirin, I'm going to start with you. The basic details of what we're reporting here.
Sure. So we know that Anthropic is expecting to have an IPO that could match or exceed the size of SpaceX's record-setting IPO quite recently. We also know, we found out a few more details about their losses, that their net losses in 2025 were nearly $42 billion, and that's a five-fold increase from 2024. So that's going to be one of the key questions going into this, right? There's this large IPO planned, a lot of excitement around the AI demand, but also questions around the very high costs needed to sustain this business.
Liana, there's a process happening here, right? In our report, we say that CFO Krishna Rao is kind of leading these earlier investor meetings. There's a confidential filing, a public filing will follow. This is your team's bread and butter, right? Take us inside what we know is happening behind the scenes.
Sure. So the story mentioned the CFO who's speaking with investors. It didn't mention the armies of investment bankers who are also there in the room or even behind the scenes trying to start to do early book building of who will be the investors that get in on this deal. These fees eventually do get paid to the banks, and it all comes down to how much does this IPO raise and at what valuation. That's another question. So you mentioned that Anthropic had been valued at $965 billion. So in an IPO, do they get to 1 trillion? Do they get to 1.5, 2 trillion? So those are all things that the bankers and the lawyers and the company, they have to figure this out, to figure out the support from investors at what valuation, can support this deal. But it's really exciting for the IPO market, which always opens after Labor Day. And we'll be following when this S1 finally hits, and we'll get a look at all the financials for the first time.
Right. Anthropic should have a lot of cash on its balance sheet. And so the question is, why do a big IPO? And Shirin, you spoke on stage, right, with Daniela Emode, the president, co-founder of Anthropic, in June, and you just put this question very directly: why an IPO? What was the response at that time?
Yeah, an IPO offers a repeatable process to raise large amounts of capital. Again, if you think about the incredibly high cost of compute, to train a new AI model at the cutting edge these days can cost billions of dollars just for one model alone, potentially. So, that's just sort of the state of play right now. So her answer was that we need to be able to raise money when we need, and IPO provides that process.
Liana, I do want to get into the process. I went back and checked my calendar. From the time SpaceX flipped its S1 public to IPO day was about 23 days. And I have a bit of shell shock from that period of time. I'm sure you and the team do as well, of how it transpired. But it happened very quickly. So we're reporting that Anthropic might flip its S1 public by the end of this month, September. What happens? How does it happen?
Sure. So you mentioned that Anthropic is already on file confidentially. So all they have to do is get their ducks in a row to make this public with the SEC. And if they want to get on the roadshow, to get on the road after this Labor Day period, analysts are saying this filing could hit as soon as next week. We haven't reported on a specific timing. We said it could be within a few weeks, but it wouldn't be crazy to see this next week because, as you mentioned, you have 10, 15 days, maximum 23 days. This all happens very fast. And IPOs are all about the market conditions. So SpaceX, sure, it's trading a little below, its price, but it's still a massive company that went public. It's trading okay. It wasn't a total disaster. So if you're another company waiting in the wings to go public, you see that and you say, well, maybe we should strike when the iron's hot. And then don't forget also OpenAI is also keeping an eye on this. So Anthropic has that to think about too. The
top line of our report, Anthropic is seeking to match or top what SpaceX raised, and on a valuation basis too, in the weeks to come. I'd also point out SpaceX just in the last 10 minutes went above $135 a share, its IPO price. Bloomberg Shirin Ghaffary covers Anthropic. Liana leads the team on Bloomberg Deals. Thank you so much. As Anthropic prepares for its IPO, the company is also addressing a key concern for its biggest customers, data privacy. According to a Bloomberg source, Anthropic plans to give businesses more control over where their data is stored when using its AI models, particularly its frontier models. Bloomberg Tech managing editor Sarah Frier is with us. Really important piece of reporting because Anthropic has been given so much credit for its commercial progress. But this was a key concern customers had. Explain what we're detailing in that report.
Well, customers were concerned about Anthropic retaining their data for a few reasons, but probably most of all because then Anthropic has their data and can train on it. Of course, Anthropic said that it would not do that. They said they wanted to retain the data in order to guard against cybersecurity threats after some of the concerns earlier this year about potential breaches of customers. They said, we'll retain the data for a while to make sure that everything is fine. But of course, that was not a popular plan with its customers, and it's deciding to give back more control.
Anthropic declined to comment on our report, but it ties very closely to what's happened in recent weeks and months. Models acting outside of the instructions they've been given, and the focus on the race with OpenAI has been about enterprise, right, and ARR. What else do we need to know from this report?
Well, Anthropic really does need those enterprise customers. It's so foundational to the success of that IPO, and they're a leader right now in the market. But there are a lot of companies that are learning from Anthropic's success. You have Google Gemini, you have OpenAI. They're trying, and even SpaceX. They're trying to do things to cater to those enterprise customers that Anthropic has. It's still a very early market, and so they do need to think about not just what do they think is the right move for cybersecurity, but balancing that against what their customers expect and require in order to retain those customers.
Bloomberg Tech editor Sarah Frier, thank you so much indeed. Now, coming up, Broadcom's looking to raise more than $60 billion in debt. We're going to break down one of the biggest bets yet on AI infrastructure. It has a very complicated structure that the team are going to explain to us. This is Bloomberg Tech. Broadcom's lining up another massive bet on AI. Bloomberg's learned the chipmakers in talks to raise more than $60 billion in debt to help Anthropic and others secure chips and computing power. That's all according to sources. Bloomberg's Ryan Gould, part of the team that broke the story. Actually, this is not as simple as Broadcom going out and raising debt for itself. Can you just explain the structure of what we've reported?
Yeah, it's a good point, definitely, to hit on at the start, because I think if you were to look at this headline, it could, mean something quite different. But to break it down, I think in the most simplistic way possible, Broadcom is essentially looking to raise a special purpose vehicle that would be financed by other partners. We've already seen them sort of hint at this. They announced a partnership with Blackstone and Apollo in June that was essentially to finance a 1 gigawatt capacity compute sort of layer. This is essentially an expansion of that. So Broadcom would go out and with those partners look to raise a chunk of money through debt that would essentially sit in a special purpose vehicle that would then go out and buy chips that Broadcom makes. I think the interesting part of this deal is that you have a situation where Broadcom is not only helping to finance customers buying its chips, but is also then supplying them itself. So it's both the customer and also the capital provider in a certain way. I think what makes this deal more interesting is that Broadcom is going to actually effectively guarantee a significant chunk of that debt and therefore help to bring down the cost and make it safer for investors who may look to participate in this SPV.
is somewhat comparable to what we saw from Nvidia and those 6 large Wall Street firms, where the compute was the collateral in that case, but the firms are just a conduit to the capital, third-party capital, doesn't come off balance sheet. I'm reading the details, so it looks like this could be up to 100 billion, right? 70 billion in senior secured debt, 30 billion junior debt. Just fill in some of the other details for us.
Yeah, so I think there's the junior piece would be essentially guaranteed by Blackstone and Apollo. The other 60 billion piece, it could be as much as 70 billion, according to sources. I think that's the key here. These are fluid discussions. Broadcom is not necessarily going out and saying it wants to raise $60 billion. I just think given the parameters of what's been talked about here, it could be anywhere in that region. And I think if you put those two numbers together, you do get something that's in the region of $100 billion. I think taking a step back and just thinking about what this sort of looks like from the wider sort of AI infrastructure rollout, these are obviously kind of novel structures. You just mentioned the Nvidia deal with the other private capital providers. It's in a way two sides of the same coin. I think if you look at that deal, you have some of the biggest, sort of largest financial infrastructure firms on Wall Street participating in that one. Here you have essentially private capital helping to helping Broadcom to sell those chips. I think. Right. We've seen this before, right? You look at things like aircraft leasing has happened in this way. You think about data centers now. I think this is kind of the evolution, and people are thinking on the fly with these kinds of structures.
And in a lot of parts of the market still have questions about it. By the way, from the equity perspective, Broadcom up a percentage point following the report. Bloomberg's Ryan Gould, thank you very much. That Broadcom deal gets right to a bigger concern overhanging the AI trade. The cost of funding it all, but record debt issuance, higher rates, growing pushback on data centers, particularly in this country, all raising fresh questions about how quickly the build-out can pay off. Delighted to welcome back to the show Erika Klauer, a founder, CIO, CEO of Science and Technology Partners. Let's start with your interpretation of the reporting about this vehicle that Broadcom has set up.
Well, thanks so much. Lovely to see you this morning. And, this is an extension of what we've been seeing for the last several months, which is extraordinary levels of debt coming to the market to build out the AI infrastructure. And the market is having some indigestion with dealing with all of this debt. Just to wrap some numbers around it, it's quite staggering. We've had over $220 billion of debt issued so far this year, which is up more than double from 2025, and that's just year to date. And of course, in 2024, the levels were just about 20. So this is quite a big jump. And not only is the debt quite expensive, but there's so much of it. So it's difficult to find homes for it all. The coupons have gone up. And so many of these companies are now having to face much higher borrowing costs than they had initially anticipated maybe 6 months ago.
The reason that I wanted to get you back onto Bloomberg Tech, Science and Technology Partners, a long bias fund, just zeroed in on the corners of the technology market we care about most. Eric, you're coming at this sort of cost of capital lens, right? For lots of people, they go straight to the circular financing question. How do you feel about that side?
Well, I think it, of course, is a concern because to offer financing to a customer and in turn expect that they will be buying your products is indeed circular financing. And so I think that this is a legitimate concern for all investors as they are examining these deals.
In the United States, particularly ahead of the midterms, there is a lot of societal debate about the impact of data centers, and there is action to push back against specific projects. Do you have to model that into your outlook for CapEx, for growth of data center?
I think this is such a good question because this gets at the heart of why we're seeing so much volatility in the market. It's not only that the cost to build out these mega AI infrastructure facilities are going to be higher because the coupon must be higher in order to get it placed, but also one will be carrying that more expensive debt most likely for longer because of two key reasons. One you just mentioned, which is that in states like Pennsylvania, New York, Texas, there are data centers that are facing whether it's regulatory or community concerns that are delaying some of the facility build outs. There are also shortages of workers to build out these facilities. And there also are chip shortages. So all of this calls into question whether or not even these AI data centers will be built on time. And every month that goes by is another month of paying this very high coupon debt that is associated with this build out.
Erika, I would really value the long bias funds action in response to what you see in the markets, right? Since June, we've seen a correction in everything across the stack: memory, compute, other parts of the supply chain. How do you respond to that?
So as a long biased fund, we really look out over the next 3 to 5 years. And despite these very serious and legitimate concerns, we see extraordinary opportunity. We still think that we're very early on in AI infrastructure build out, and more importantly, AI uptake. And so far this quarter, we've seen extraordinary results across many different sectors where earnings have come in ahead of expectations directly because they're using AI to their advantage, whether it is to control costs or advance innovation. And I think that is just the start. So what we do is we look at where we think that the most innovation will occur in the coming years. And we come up on the technology side in areas like memory, which have really seen a pretty sharp correction in many of those companies. We look to add to the companies where we think that there are best-in-class players. We look for optical interconnect as a replacement to copper as an extraordinary area of opportunity. We look to robotics, we look to space exploration. And then there are also incredible innovations right now in healthcare, where companies are really using technology to advance their own discovery. So for example, in areas like diagnostics, we've seen big jumps, and we've seen a much more favorable regulatory backdrop and reimbursement backdrop for many of those companies as well.
Erika Klauer of Science and Technology Partners, it's great to have you back on the program. Thank you for responding to what is a pretty big story in the markets today. Now, coming up, Samsung is following in SK Hynix's footsteps in returning shareholders buybacks in what could be the largest ever in South Korean history. More on that next. This is Bloomberg Tech. Software companies are deploying increasingly aggressive strategies to counter a crisis of confidence in their outlooks driven by fear that AI tools and startups will replace them. Some investors, meanwhile, see it as a chance to get the potential survivors of the SaaSpocalypse at a discount to the high-flying prices of the 2010s.
And that can be a great opportunity for investors to sort among companies that can survive and that maybe might not survive, or at least might not survive at the value they've been at. And so that's an area that I think for the long-term investor is really worth investigating. I do think the emphasis is on long-term, because it's hard to imagine that terminal value concerns can be alleviated in any one particular earnings season.
Let's discuss the tactics software firms are using with Bloomberg's Brody, who's published on this morning. Really interesting read. Can you just explain the basic tension in the story to us?
Software companies have had a pretty terrible year and a half, right? Investors are convinced they're going to get replaced by AI. There's been a massive valuation meltdown. And by and large, software companies can't convince the market on virtue of their business results that, their AI products are growing or accelerating revenue. And so they've turned to some kind of zany, cosmetic, sometimes aggressive strategies, swapping out their leaders, fighting with analysts on earnings calls, renaming products to make them sound more like AI. And so in this story, we just kind of compile all the different novel, zany, whatever you want to call it, strategies that they've been trying to use to beat the SaaSpocalypse.
Okay, so changing business strategy or talking up your competence in whatever area is very different to doing a buyback. Buyback is just a very shareholder-friendly policy.
Yeah.
Bring us to that part of the story.
Right. Failing all of the strategies we just talked about, you do a big buyback, and that makes the market happy. I think the gnarliest one we saw was Salesforce, which borrowed $25 billion to buy back $25 billion in its own stock, and now you're paying interest for doing a buyback. And I think that one raised some eyebrows on Wall Street, but it just shows that they're really ready to pull whatever lever they can to help boost morale.
Bloomberg's Brody Ford, thank you very much indeed.
Let's
take a look at today's big number, $80 billion. That's how much Samsung's planning to return to investors this year, joining SK Hynix in sharing some AI windfall and putting in motion the largest shareholder return program in South Korea's history. Bloomberg executive editor Peter Elstrom's back with us. There was reporting on this, but Samsung has followed on from SK Hynix's actions earlier in the week.
Yeah, talk about pulling levers to try to help your share price. You're seeing this out of South Korea in spades. Yeah, so today we got Samsung Electronics talking about returning $80 billion in cash to their shareholders. That'll be through dividends and through some buybacks. They haven't said exactly how they're going to split those numbers. But as you say, it's going to be one of the largest buybacks in history, the largest ever in South Korea. It comes shortly after SK Hynix said it would spend about $29 billion through November in order to buy back shares. Both of these companies are making tremendous amounts of money, and they've said that they want to give about 50% of their free cash flow back to shareholders at this point in one form or another. And a lot of that is driven by the fact that their shares are down quite a bit.
So that's interesting. In SK Hynix's case, the stock was down 50% from a June peak, but still up 150% year to date. And there was some dilution when they did the ADRs. What was Samsung's motivations for why now?
Samsung shares are not down quite as much, but they're still down a lot. They're down about 25% from the peak, and they're making a tremendous amount of cash. They're going to make about $275 billion in operating profit this year based on analyst estimates. Huge numbers even for them compared with prior years. And they're looking at that share price that's come down quite a bit. They don't see the optimism that they saw in the past. They'd like to return some of that money to shareholders, probably buy back some stock. We haven't gotten the specifics on that, but buy back some stock to be able to push the shares back up and give shareholders a reason to buy the shares again.
But isn't Samsung doing super well, tons of profits and winning this AI thing?
Well, Samsung is coming from behind. Very unusual position for them compared to SK Hynix. SK Hynix had jumped out to a big lead in the HBM memory chips that are used in AI data centers, of course. So Samsung has gained a lot of momentum in that area. They're competing, in some cases, exceeding SK Hynix in that field, but it's a very intense competition at this point. They're doing very well in memory chips. They're making a lot of money because prices have gone up so much. That's why we're going to see record profits this year from them. Could be pretty phenomenal numbers going forward, and they'll probably have a pretty big year next year too. So they want to show shareholders that they can give some of this money back to them.
Bloomberg's Peter Elstrom, thank you very much indeed. Happy Friday. Coming up on the show, the first week of a trial accusing Meta of misleading the public and harming children has wrapped up. We'll discuss the arguments, what we learned, and what happens next. This is Bloomberg Tech. Welcome back to Bloomberg Tech. It has been a big week in the world of technology. Actually, the Nasdaq 100 is up modestly this Friday, but on a weekly basis, down for its first weekly drop since the week that ended Friday, July 24th. There's been a lot of factors in that, and probably Bitcoin's the best case study. So Bitcoin is on track for its biggest or best week in about 3 years. One of the big factors was the Treasury's intervention in the bond market. The Treasury saying it would at least double the size of long-dated bond buybacks. That is kind of what has been a catalyst outside of technology-specific factors. We are bracing for a big earnings print next week from Nvidia, but risk on has taken Bitcoin with it. There is a big story playing out in technology this week, and that is Meta, which just started a legal fight. Marianne Franks, professor at George Washington University Law School, joins us to talk about what we've learned so far. This trial is an accusation by 29 states that Meta deliberately designed its platforms to keep children hooked to them and also deceive the public with some privacy breaches. But it's a complicated split of different state laws and one federal privacy law. Could you start by explaining the distinctions between state and national level?
Sure. So the federal claims have to do with this federal statute that protects children's privacy under 13. Essentially, it says that if you are a company that wants to collect data about children under 13, you have to get parental consent. So the argument there from a federal perspective is that this company, Meta, and its products have violated that federal statute. And then you have these, as you said, 29 states that are saying, in addition to that, there's violations of state consumer protection laws, and those mostly focus on claims that the company has made to the public about the safety of its products and services, in contrast to the internal documents and research that Meta has, or they claim that they do have, that shows that these things are not true.
Marianne, really grateful for your domain expertise. You know, to like really simple level, 29 states sue Meta, but this is playing out in a specific court where there's an advisory jury, and the judge still needs to take that advice and decide both state and federal laws. And so, like lots of people, that's confusing. How best to simplify it?
It is really difficult to simplify. It's a complex case. It's what's known as a MDL, a multi-district litigation. And it happens when you've got several claims or many thousands of claims, as you do here, that all seem to allege similar facts, similar harms, involve the same company, Meta here. And it's a little bit like the tobacco litigation and settlements you saw in the 1990s. And so what you have is one judge consolidating all of these cases and taking what's called a bellwether trial to take a look at some of these essential claims and try to figure out what the gist of them really is, how strong are the parties' arguments, and then see to go from there whether you can move these parties to settlements.
The big headline of the week was that Meta, by its own calculation, faces a $1.4 trillion potential penalty. Right, which my understanding is just all of the potential violations and counts totted up in aggregate if they were to be found in breach of every single one. Your legal experience and expertise of that potential penalty, please.
I think, first of all, it's important to note that that's a number that Meta has given. This is not the number that the AGs themselves, right? So the AGs are saying we're really looking more at 200 billion, which is still, it's a lot of money, right? But when you think about the fact that you've got, $18 billion of quarterly profits for Meta, not that much, right? So, but I think Meta's putting out that number because it's trying to create the impression that this would be existential, right? This would be a Meta-ending kind of fee. So I think that it's important to put that in context. And the idea that that's going to be the result here, I think, is highly unlikely.
Are there any precedents in the case law that will give us a guide of what might happen here?
It's really difficult to say. I mean, we all know that in the last few months that we have seen some really important cases go forward against Meta and other social media companies that, 10 years ago or 20 years ago simply would have been inconceivable because the way that the tech industry's immunity shield, the federal immunity law, Section 230, was interpreted, these cases never even got to this stage. And so this is one of the first times that we're really seeing what's under the hood of these major social media companies. That's the biggest deal here. And it is somewhat analogous, as some have said, to some of the tobacco litigation, because there were similar claims there that tobacco companies were saying one thing, but they knew something else at the same time. And that's what everybody is paying attention to now.
You frame this in the distinction between what Meta says publicly and the practices it has in place. It's also a technology story, right, about the platforms themselves. How important will it be, therefore, in terms of what we hear from Meta and who at Meta we hear from?
Extremely important. Those are going to be the kinds of things that are going to have the biggest impact, not just on the judge, but on the advisory jury, and maybe most importantly, on the public. It's going to be a question of pointing out that there are documents where Meta said something publicly, made promises to parents, made promises to Congress. And then you look at some of the internal documents and say, at the same time you said these things, you also knew this was going on. It's direct, the argument is that this is in direct contradiction to what you were saying publicly. So what these individuals who represent the company, their words and what it is that they say to themselves when no one is looking is really going to become, I think, the heart of this trial.
Meta has, commented quite regularly in the lead up to this case. And again, that $1.4 trillion potential penalty is a calculation Meta's made, not the states that are suing themselves. Just in 15 seconds, do you see an outcome here that's tangible in the first week or not?
Maybe not in the first week, but again, there's the question of the ultimate outcome of liability and whatever that dollar amount happens to be. But the much bigger question is, what is the public going to learn? What is Congress going to learn about what these companies were actually doing? What did they know? When did they know it? And what are they going to have to change going forward?
Marianne Franks from George Washington University Law School, thank you very much. As Meta's being sued by this bipartisan coalition of states, we mentioned the company says it could face potential penalties of as much as $1.4 trillion if it loses the trial, which raises existential questions about the future of its core business. Bloomberg's Ryan Vlastelica from the equities desk is with us. You're looking at this from the stock perspective, right? Are investors really worried about the legal headwind here?
Well, we've seen the stock come under pressure over the past several days, and it does seem like it coincides with the start of the trial. Like you mentioned, this could be a potentially existential risk for the company. The problem, according to the investors I've spoken to, is that it's very difficult to game out what the ultimate impact is going to be here. We don't know what a verdict would be. We don't know what the penalties would be. We don't know what appeal systems would look like. There's a lot of big questions out there, but it is another risk for the company at a time when people are already sort of souring on it. We've had a lot of questions about how much spending it's doing on AI, and it seems like the ROI side of things is harder for them than it is for other companies like Amazon or Microsoft or so forth. So this is just another element of uncertainty for a company that's already been living under a bit of a cloud.
Right, Ryan, just go back to that key chart, the underperformance of Meta. Give size and scope on that underperformance quickly.
Yeah, I think it's down double-digit percentage this year. I think Tesla's the only other name in the Mag 7 that is sort of comparable to that. NASDAQ 100 is doing pretty well this year. I mean, that's largely due to the semiconductor sector, but Meta is a very dramatic underperformer, especially relative to the other AI spenders.
Memory chips in the news cycle. You've been taking a look at the sector. What are you writing about?
Well, we've seen memory, as has been the case for a while, become under a heavy amount of volatility. We saw the group kind of try to rebound earlier this month, but since then they've really taken another step lower. There's a lot of uncertainty out there about how durable is AI spending going to be and how durable is the growth going to be for these companies. People still view them as pretty attractively valued, and they still see a pretty strong fundamental backdrop. And I would note that SanDisk recently had an investor day where it gave some very positive long-term financial targets. But there's a lot of debate about here, like maybe they've already seen peak growth, maybe they've already seen peak enthusiasm, and what is going to be the next catalyst to help them regain their leadership. Right now, it seems like people are having a difficult time answering that question as far as what could take these stocks back to the records they were at not all that long ago.
Bloomberg's Ryan Vlastelica, thank you very much indeed. Coming up, Samir Kaul, Managing Director of Khosla Ventures, is going to join us to discuss the firm's investment in Discovery Loop. That's the AI startup from Google's former chief scientist, something that was massive in the news cycle over the last 10 days. This is Bloomberg Tech. A new AI startup called Discovery Loop has set out to boost the speed of scientific experimentation. It was started by former leaders at Google, including the company's chief scientist, Jeff Dean, and has backing from high-profile investors, including Khosla Ventures, which co-led the seed round. Khosla Managing Director Samir Kaul is here to talk about it. Samir, welcome to the program.
Thanks a lot,
This
Ed,
is
for having
one,
me.
You're very welcome. This is one where people kind of want the backstory. So like all good stories, let's start at the beginning. How did this all come about?
Well, there's a lot of talk about this magical deck that apparently has been out there for the financing. And,
yes.
and as the guy that's leading the seed round, I'd like to see the deck, which I've yet to see. So there's a lot of lore already about this. Look, when guys like Jeff Dean and his team, who are responsible for so many innovations at Google, TensorFlow, TPUs, Gemini, they come to you and say, look, we're coming up with we're going to leave after a collective 80 years at Google to start a new company that's going to be based in engineering and research and improving science. How do you say no? We were just honored and thrilled that Jeff considered us to co-lead this round.
Samir, you will appreciate, right, that the headlines of Jeff, but others leaving Google and the kind of the changes in structure they made, that was big news. And so what was kind of the latency? When did these conversations about Discovery Loop start relative to that period of changes at Google?
It's all relatively recent. So this isn't something that's been hatched, at least with us, for a year or something along those lines. It's relatively recent. It moved very quickly just because of the caliber of the founders, and it's very consistent with our thesis. So we were the only venture firm in the first round of OpenAI because we believed in LLMs. We were the first money in a company called General Intuition because we believed in world models. And RSI, we believe, is going to be the key to advancing science and engineering principles.
Yes.
RSI, it's great. AI is going to design experiments. It's going to test and figure out what the results of that experiment are going to be. And then it's going to design another thousands and thousands of parallel experiments in a closed loop system to give you answers about, what type of magnets should be used for fusion, types of battery materials for solid state batteries for electric vehicles, for drug discovery, for drug development. I mean, it's just an incredible tool, like LLMs, like world models.
Samir.
And to have a guy like Jeff and his team lead that effort is just a dream.
So that dream is what I want to get into, because OpenAI, Anthropic, Google DeepMind, like other larger labs, are looking at similar domains. Mm-hmm. That's not their sole focus. So what is the distinction with Jeff and the Discovery Loop team? What is their technical advantage?
Well, they've developed many of the principles that allow you to do RSI. And second, I think the large companies, especially if you're public, you can't be as focused and take as many risks as you can as a private company. Jeff's sole focus with Sanjay and Oriel and Kwok are going to be RSI. That's it, for science and engineering. He doesn't have 15 other masters to respond to. That's going to be his sole focus. He's going to clearly be able to recruit a killer team and stay focused on that big prize.
You started this conversation saying, if there was a pitch deck, I didn't see it. So it sounds like, the evaluation of the potential here was on their legacy, their work to date in this field. Is that fair?
Well, it's what the potential opportunity is. The company that we've seen it already. You've talked a lot about Anthropic on your show this morning, but Anthropic and OpenAI and pioneering frontier models, it's been speculated that combined they're already at $100 billion of revenue and nearly $2 trillion of market cap. And if you believe that RSI is equally as profound and as impactful, and then you've got four gentlemen who are as distinguished as these four, it makes it a relatively quick investment decision in our investment committee.
We're getting into the domain of the opportunity as referenced by the potential return. And it's so interesting, like Discovery Loop is also structured as a public benefit corp, right? So going in at that seed stage, how do you get sort of the venture scale return from that structure?
Well, I don't think that structure inhibits that at all. In fact, that structure may attract different types of engineers that want to work on this problem and be at a public benefit corporation. I mean, look, we invested in OpenAI when it was still a nonprofit, and it may be the most profitable investment we've ever made in 25 years.
Right. I appreciate you guys are not disclosing the size of the round nor the valuation. It's a seed stage round. But as we've written about a lot this year, the term seed is starting to not really mean anything. A coconut seed, a mango seed round. Think about like humans and, you're laughing, but think about humans and, right?
Yeah.
A small group of individuals raising hundreds of millions of dollars out the gate at a very lofty valuation. Would you say that Discovery Loop is on par with that level?
Well, the prize is big enough that it warrants the round and the valuation that Jeff and his team have achieved. Let me just put one thing in perspective, Ed. So when I moved out to Silicon Valley in 2005, soon after the word unicorn was coined for a company with $1 billion valuation, meaning it was so rare it was like a unicorn. You fast forward a decade or so after that word was coined, you now have 20 or so $1 trillion companies, and a unicorn by the old definition is being funded on a weekly basis. So you have to reset everything in terms of what valuation gives you venture scale returns, what exactly a seed round is, because we may be sitting here in 5 years where there's a dozen or so $10 trillion companies.
Let's catch up in that time frame, and we'll see if you were right.
Well,
Samir of Khosla Ventures, it's been great to have you on Bloomberg Tech. Thank you very much. Some other news headlines in talking tech. First up, Chinese robotics startup Dexmol, backed by tech giant Alibaba, is seeking a valuation of $3 billion in an ongoing funding round, showing strong investor appetite in the country's embodied AI advancements. Follows Unitree Robotics raising $904 million in its Shanghai debut this week. Plus, OpenAI released a new feature that would allow ChatGPT to read, write, and send text messages in a move sparking privacy concerns. OpenAI has stressed that the feature would require a user's consent, and the plugin would run locally on Mac and use existing operating system tools. And SpaceX and AST SpaceMobile have expressed interest in acquiring Grain, a company providing wireless phone services directly from space. Sources say Grain asked interested parties to submit preliminary offers with hopes of reaping $6 billion from selling its licenses. Elon Musk weighed in on X, responding, quote, "not true," to the report. Coming up, all eyes are on Nvidia as the tech giant set to release its second quarter earnings next week. It's the big one. This is Bloomberg Tech. Nvidia's in early talks with South Korean chip startup Rebellion's about possible collaboration, sources say. Nvidia CEO Jensen Huang met with Rebellion's co-founder and CEO Sung-Yoon Park on the potential deal, which could include a technical partnership. The chip firm raised roughly $850 million from investors, including SK Hynix, Samsung, and Arm Holdings, and was recently valued at $2.3 billion. Let's stick with Nvidia. Its highly anticipated second quarter earnings are set to come out next week. The street sees sales of $92 billion to $95 billion. Either way, double what it was 1 year ago. Let's discuss what to expect with Kunjan Sobhani, senior semiconductor analyst with Bloomberg Intelligence. Double a year ago. But a year ago was double the year before, right? Yep. The main point is that, the momentum in Nvidia's growth, it seems intact.
Yep.
What are you looking for?
I mean, we again expect decent beat and raise, but I don't think that will be enough. It never has been in the.
You're talking about the market's reaction.
For the market's reaction, yeah. I mean, if they get close to the 100 mark, that will be something. We don't expect that given the supply constraints. But the focus right now is on three key areas. One, the concerns around vendor financing and off-balance sheet obligation. Second, we would love to hear something positive on the China end. Right? And one positive key impact for which is the 3Q guide. This is the first time ever that Vera Rubin, we now expect to ramp day one at every single hyperscaler, frontier lab, cloud provider, neo cloud, you name it, which has not happened with Blackwell or the past revisions.
So let's talk a little bit more about that. Vera Rubin, Vera CPU, Rubin accelerator or GPU, latest generation. And what I see from executive NVIDIA is constant commentary that it's in full production, it's in ramp. So you think that this is out there in the real world. Is it where you think there might be a surprise in terms of contribution?
There could be a positive surprise. We at this point do not expect anything negative surprise. Again, the reason they're out and about so much is the last time when this time of the year Blackwell was ranking, there were a lot of hiccups. So they want to avoid any concerns or fears or rumors around hiccups. The only one thing on the negative side we're looking for is gross margin impact. We don't expect, investors are not hoping or bracing for a lot of gross margin impact. Remember, whenever a new product ramps, it's a gross margin headwind initially. But from what the company has suggested, it might not be as big of an impact this time around.
Jensen Huang will get questions about circular financing, I'm sure. So let's go to your China point. Right now, the assumption is zero from China. But you want to see NVIDIA say, this is how we're going to be able to do business, real quick.
Yeah, we really want to hear that. I mean, this has been something that has been dragged out, and we just saw news headlines, right, that China is now enabling. There are orders in the book. We really want to see this come to revenue, at least in the tens to $20 billion to start with.
Bloomberg Intelligence's Kunjan Sobhani, who leads our research of NVIDIA and the other fabulous chip names. Thank you so much. That does it for this edition of Bloomberg Tech. Seriously, an astonishing week in technology. In markets, also in the news flow, and Anthropic's been the big one. So much to recap on the podcast. You know where to find it on the Bloomberg terminal, as well as online on Apple, Spotify, and iHeart. Markets are ending the week higher, 0.6% on the Nasdaq 100, but down on the week and set for the first weekly drop since that final week of July. Have a great weekend, everybody. This is Bloomberg Tech.